Welcome to Keys and Capital, where real estate, lending, and economics come together. Today we're unpacking the Federal Reserve from its roots straight through to its grip on housing. The Federal Reserve System acts as America's central bank. It pushes for steady economic growth while keeping the financial system stable. Supervision of banks falls under its watch, too. A smooth payments network for the dollar stays high on its list. Consumer protection and community development round out the mission. Unlike many other central banks, this one runs with real independence. Monetary choices skip presidential or congressional sign-off. No tax dollar fund it either. Board terms stretch across election cycles. Crises like the Great Depression widened what the Fed handles. The same happened after the Great Recession. Structure includes a Washington board plus 12 regional banks. The Federal Open Market Committee sets interest targets. Public oversight mixes with private input from those regional spots. Let's trace the origins back further. In November 1910, six powerful men slipped away to Jekyll Island off Georgia. They called it a duck hunt to dodge reporters. Senator Nelson Aldrich led the group. Henry Davison from J.P. Morgan joined him. Arthur Shelton served as Aldrich's secretary. Frank Vanderlip represented National City Bank. Paul Warburg from Kuhn Loeb came along too. Assistant Treasury Secretary Piatt Andrew completed the set. They used first names only during travel and became the First Name Club. Warburg, a German-born banker, had already slammed the old U.S. setup as behind the times compared with Europe. Their talks shaped a reform plan for banking stability. That framework fed into the Federal Reserve Act later. The whole meeting stayed hidden for years. The real spark came from the panic of 1907. A failed corner play on United Copper stock kicked things off in mid-October. The New York Stock Exchange plunged nearly 50% from its earlier peak. Bank runs hit trust companies hard. Knickerbocker, trust the city's third largest, folded completely. Regional banks yanked reserves from New York outfits. Liquidity dried up fast during an already rolling recession. J.P. Morgan pulled together a bank syndicate to pump in cash. He basically played central bank for a while. The panic turned a recession into one of the worst squeezes before the Great Depression. No formal lender of last resort existed back then. That gap pushed the Aldrich-Vreeland Act of 1908. It launched the National Monetary Commission under Aldrich. Commission findings, plus the Jekyll Island ideas, led to the Federal Reserve Act. Congress passed it December 23, 1913. President Wilson signed it that same day. The law created Federal Reserve notes as national currency. It built an elastic money supply along with rediscount tools and better supervision. Now, how does the Fed steer the broader economy? Its dual mandate targets maximum jobs and steady prices. The FOMC picks the federal funds rate target. That rate hits what banks charge each other overnight. Since 2020, it swung hard. Cuts dropped it to 0.25% in March 2020. It stayed near zero until 2022. Then aggressive hikes fought inflation. The range hit 5.25 to 5.5% by mid-2023. Gradual cuts started late 2024. It sits at 3.75% as of May 2026. Quantitative easing ballooned the balance sheet. Early 2026 assets hovered near $6.6 to $6.7 trillion. Treasuries made up about $4.47 trillion of that. Mortgage-backed securities added $1.97 trillion. Later, the sheet settled around $6.5 trillion. Asset buys push long-term yields lower. They spur risk-taking and keep credit moving. Borrowing costs, investment consumption, and inflation views all shift because of these moves. Emergency lending in 2008 and 2020 showed the crisis side of its work. Housing feels these levers directly. Low federal funds rates plus quantitative easing squeeze mortgage rates down. Affordability rises and demand climbs. Purchases of mortgage-backed securities prop up housing finance. Home prices climb through the wealth effect. Owners feel richer, so they spend and borrow more. Post-2020, near zero rates and big mortgage-backed security buys lined up with fast price jumps. Rate hikes since 2022 raised costs and cooled demand. Price growth slowed as a result. The wealth effect boosted existing owners, yet made it tougher for new buyers to enter. Critics say the expanded toolkit after 2008 and 2020 gives the Fed too much sway over markets and wealth splits. Accountability feels light without enough democratic checks. Independence keeps policy clear of short-term politics, but that same shield raises questions about concentrated power. Supporters point out the dual mandate and crisis tools stopped worse downturns. Financial stability stayed intact thanks to those steps. Regional banks spread some influence, though. New York still carries heavy market weight. Tools grew in reaction to repeated crises. Congressional oversight and public review still apply, though. Key points stand out clearly. The Fed traces to the 1907 panic and the 1910 Jekyll Island gathering with Aldrich, Warburg, Vanderlip Davison, and the rest. The 1913 Act sealed its start. Monetary policy runs through the federal funds rate now at 3.75% and a balance sheet over $6 trillion. Employment and price goals guide every choice. Housing reacts straight to rate shifts and quantitative easing moves. Recent cycles showed both stimulus and cooling sides. Independence and crisis response worked well in many eyes. Debates continue on how far that power should reach in today's economy. More than a century after its quiet birth, the institution still sits at the center of U.S. economic management. Thanks for tuning into Keys and Capital.